You wake up, check your bank balance, and feel reassured by numbers glowing calmly on a screen. Those numbers feel like ownership, like control, like proof that your labor has been safely stored. But history has a cruel habit of punishing assumptions made during quiet, comfortable mornings. Because the truth is unsettling, money in a bank is not money you own. Most people believe deposits are possessions, stored like gold bars inside vaults with their names attached. That belief is comforting, intuitive, and catastrophically wrong when systems begin to fracture. Legally, the moment you deposit money, ownership transfers away from you entirely. You become a creditor, and the bank becomes the owner of what you thought was yours. This distinction sounds technical, harmless, even boring, until the day it suddenly becomes everything. Because creditors do not have access rights. They have claims, and claims depend on solvency. If the institution fails, your money joins a long legal queue of promises. And history shows those queues move slowly, selectively, and often never reach the back. This structure was not accidental, nor was it hidden from lawmakers or financiers. Modern banking is built on fractional reserves, leverage, and trust replacing physical custody. Banks do not store deposits. They transform them into loans, assets, and speculative instruments. Your paycheck becomes someone else's mortgage, bond trade, or liquidity buffer within hours. In exchange, you receive convenience, interest crumbs, and the illusion of immediate access. That illusion holds only as long as everyone agrees not to test it simultaneously. The moment trust wavers, access becomes conditional, delayed, or suspended entirely. À tel point, Custodyville not possède. This is not theory. It has happened repeatedly across centuries, continents, and political systems. In 1933, American banks closed their doors while depositors stared helplessly through locked glass. Balances existed on paper, but withdrawal became illegal overnight by presidential decree. The system survived, but ownership was temporarily suspended by necessity and fear. Decades later, Argentina froze accounts during its currency crisis, calling it stabilization. Citizens discovered their savings were trapped while inflation devoured purchasing power daily. In Cyprus, depositors were bailed in, funding bank rescues with their own money. Balances above insured limits were haircut, confiscated, and legally justified after the fact. Lebanon delivered the most brutal modern lesson in custody illusion. Banks imposed informal capital controls without legislation, courts, or democratic approval. Depositors were rationed, converted, and effectively erased by inflation and arbitrary restrictions. The money existed digitally, but access depended on permission that never arrived. What these episodes reveal is not corruption, but design under stress. Banks are not vaults. They are balance sheets prioritizing institutional survival. Depositors rank below secured creditors, derivatives counterparties, and systemic stability concerns. Your savings are subordinated to the system you were told existed to protect them. Governments promise insurance, guarantees, and backstops to preserve confidence. But those guarantees are political commitments, not physical reserves. Deposit insurance funds cover fractions of total deposits under optimistic assumptions. They function only when failures are isolated, not systemic. When many institutions fail together, guarantees become rationing mechanisms, not reimbursements. Claims are processed slowly, inflation adjusts payouts downward, and purchasing power vanishes silently. The letter of protection remains, while its spirit dissolves under emergency conditions. Custody then becomes conditional on patience, politics, and macroeconomic triage. Digital money accelerates this dynamic rather than eliminating it. As cash disappears, every unit of currency becomes permissioned access within centralized systems. Accounts can be frozen, limited, flagged, or reclassified instantly by software. Physical escape routes shrink, while administrative control expands invisibly. Central bank digital currencies promise efficiency, inclusion, and stability. They also formalize custody, separation between user and issuer permanently. Your balance becomes a revocable ledger entry governed by policy parameters. Ownership transforms into usage rights contingent on compliance and macroeconomic goals. This shift does not require malice. It requires stress. Crises justify controls that later become permanent infrastructure. What begins as temporary safeguards often survives as standard operating procedure. Custody becomes behavioral, not legal, shaped by incentives and restrictions. The uncomfortable reality is that modern finance prefers controllable users to sovereign holders. Liquidity is managed, flows are guided, and exits are discouraged quietly. Money works best for institutions when it circulates, not when it escapes. True ownership threatens velocity, leverage, and systemic predictability. This is why alternatives historically emerge during moments of distrust. Gold, cash, foreign accounts, bearer assets, and decentralized instruments resurface cyclically. They represent custody without permission, value without counterparties. And they always attract scrutiny precisely because they limit institutional control. Every era frames this conflict differently, but the pattern remains identical. Systems prioritize stability. Individuals seek autonomy when stability falters. Custody sits at the center of that tension, rarely discussed during calm periods. Only collapse forces the question into public consciousness brutally. Most people never ask who owns their money until access disappears. By then, the answer arrives too late to matter operationally. Understanding custody is not paranoia. It is literacy in modern finance. And literacy determines survival when trust becomes negotiable. The greatest illusion is believing safety comes from numbers on screens. Safety comes from understanding structures, incentives, and legal realities beneath those numbers. Custody is not where your balance appears. It is who controls withdrawal. And control, once surrendered, is rarely returned voluntarily. If custody is belief, then crises are the moment belief is audited without mercy. Systems reveal priorities only when forced to choose between individuals and survival. And history shows survival always wins, even when promises say otherwise loudly. Custody collapses quietly while explanations arrive later, wrapped in necessity. Banks do not fail like businesses. They fail like infrastructure under invisible pressure. When liquidity evaporates, balance sheets become triage rooms for competing claims. Deposits are liabilities, not sacred trusts, despite marketing language suggesting safety. The law agrees with accounting, not intuition, when institutions begin collapsing. In bankruptcy, hekematis ordanvanis or longevity of customer relationships. Secured creditors stand first, derivatives counterparties next, governments nearby. Depositors wait behind those who structured risk professionally and negotiated protection earlier. Ownership myths dissolve when courts enforce contracts instead of expectations. This hierarchy explains why bail-ins replaced bailouts after global financial crises. Taxpayers revolted against rescuing banks. Regulators shifted burden inward instead. Deposits became shock absorbers, legally converted into recapitalization tools. Your savings transformed into emergency capital without consent or negotiation. The language softened, but the mechanism hardened permanently after 2008. Resolution regimes now plan for depositor participation before crises even arrive. Living wills, stress tests, and recovery frameworks assume losses must land somewhere. Custody is designed to fail gracefully for systems, not painlessly for individuals. This reality becomes sharper as financial life migrates fully into digital rails. Cash once provided anonymous, bearer-based custody outside institutional balance sheets. Digital money removes that exit, centralizing records, permissions, and reversibility. Every transaction becomes observable, controllable, and ultimately interruptible. Programmable money does not merely record value. It enforces rules automatically. Spending categories, geographic limits, expiration dates become technical possibilities. Custody becomes dynamic, adjusted in real time according to policy objectives. Ownership fades into conditional participation within a governed ecosystem. Proponents argue this enables stability, crime prevention, and targeted stimulus. Critics warn it erases the last boundary between citizen and monetary authority. Both are correct, depending on whether systems remain benevolent under stress. History suggests stress eventually tests every benevolent design harshly. When inflation rises, access restrictions appear faster than official acknowledgments. Withdrawal limits, transfer delays, compliance reviews become normalized responses. Each measure framed as temporary, each rarely removed entirely afterward. Custody shrinks incrementally, unnoticed until exits feel narrow. People assume diversification protects them, but diversification inside one system is illusion. Multiple banks, accounts, platforms still rely on shared clearing and settlement infrastructure. When the core freezes, branches follow regardless of brand names. True diversification requires jurisdictional, legal, and custodial separation simultaneously. This is why wealthy actors behave differently than retail depositors. They hold assets directly, not through pooled vehicles vulnerable to suspension. They diversify custody across borders, instruments, and legal regimes deliberately. Their exposure is structured, not concentrated in convenience-driven accounts. Custody Literacy separates those who react from those who reposition early. Understanding what you own versus what you access changes decision-making fundamentally. It reframes savings as strategy, not storage, under modern financial architecture. And strategy matters when trust becomes rationed resource. None of this implies abandoning banks entirely or embracing extremism. It implies recognizing banks as services, not vaults of personal sovereignty. They optimize efficiency, not preservation of individual autonomy during collapse. Expecting otherwise misunderstands their function under capitalism. The future of money will not announce itself with sirens. It will arrive through convenience, incentives, and gradual normalization of controls. Most people will welcome it until friction appears unexpectedly. Custody disappears quietly, not violently, until questioned too late. The real risk is not total collapse, but partial access under pressure. Limits that function today become ceilings tomorrow, floors later. What you can withdraw, transfer, or convert narrows invisibly. Ownership becomes theoretical while permission governs reality. Every generation rediscovers this truth through different mechanisms. Capte Gold Césure, Bancolide, Sriskli. The names change, the justifications evolve, the outcomes remain consistent. Those with direct custody adapt, those without negotiate with systems. Understanding custody does not guarantee safety, but ignorance guarantees vulnerability. The system rewards participants who understand its boundaries and design constraints. Blind trust exposes individuals to systemic decisions beyond personal influence. Preparation begins with clarity, not panic or ideology. Money feels personal, but custody is political, legal, and structural. Your relationship to it is mediated, conditional, and revocable. That does not make modern finance evil. It makes it honest. Honesty allows planning instead of shock when conditions change. The question is not whether custody will be tested again. History guarantees stress, cycles, and moments of enforced reprioritization. The question is whether you understand where you stand in hierarchy, because hierarchy decides outcomes long before explanations are written. When access matters most, structure matters more than balance. And those who understand custody before crisis never ask afterward. They already positioned themselves within reality, not illusion. That is the difference between surprise and preparation.